Hi, everyone, for coming in on this webinar. We'll begin briefly. We'll just give it another minute to see if there are more participants coming in. Just by way of introduction, I'm Ashley. I lead the credit and credit risk analytics practice at Aptiva. I'll be talking predominantly on the ICAAP aspect of today's webinar. I'm joined by Satya Vemireddy, who leads the asset liability management practice at Aptiva. He will speak in specific to the IRRBB part of things. So to get this show going, let me just share my screen. What we'll try and cover today is we are operating under the assumption that ICAAP is not a new topic, isn't it? As in most people who've joined today's call are practitioners. There is an assumption that everyone's familiar with ICAAP. So the theme for today is to talk about what the industry, especially in UAE, is doing in response to CBUAE's latest guidance on ICAAP, what we think are particular challenges as part of this new guidance, keeping in mind that the first date of compliance to these guidance is coming up in just about 2 months' time, March 31st for most banks. And I'm assuming for most people on today's call as well, your institutions are looking to meet with that regulatory guideline. So, we don't quite have a table of contents, but we will try and cover key themes in terms of what the key changes are when it comes to risk assessment methodology, when it comes to governance, when it comes to stress testing, capital planning. And I'll take about 20 minutes to go over these topics before I hand it over to Satya, who will talk to the interest rate risk and the banking book related aspect. Typical consultant slide, sorry about that. Building blocks of ICAAP, and this honestly hasn't changed in the last 6 years. The building blocks remain pretty much the same. ICAAP looked in concomitance with what the regulator does in terms of supervisory review process. So focusing on the ICAAP aspect of things, ICAAP has always involved a lot of focus on governance, roles and responsibilities, who needs to do what, SLAs, and then there are particular areas that have been highlighted by the Central Bank of UAE, which we will go in detail. Aspects related to adequacy of capital, some interesting points that the regulator has I would say highlighted. A lot of these points have always been in existence, but what has changed is the emphasis on some of these Pillar 2 and Pillar 1 risks. Stress testing, again, has always been part of the ICAAP process. The regulator this time around also has made some interesting comments on requirements when it comes to stress testing. Then, ICAAP, there's the documentation process, which in itself, anybody who's prepared an ICAAP document would know is a fairly long document, 100+ pages easily, goes into fair detail on methodology aspects, description of the capital adequacy or lack thereof, stress testing and such like. But what we are seeing in UAE is over the past few years, the level of engagement of the regulator has been increasing, especially when it comes to the regulatory stress tests, which have always been in existence the last 5 or 6 years. So there's been an increase in conversation between banks and the regulator in the guise of stress testing. But now with ICAAP also coming into picture, a lot of the banks have received comments from regulator, apart from the guidance, which sort of every bank has to comply with. A lot of banks have received individual comments, which they're also trying to remediate as part of this ICAAP. So, and I say this because this is slightly in contrast to other regulators in the region. And there are two extremes, isn't it? One, there is SAMA, who has SAMA, the regulator in Saudi, now called Saudi Central Bank, has always had a very stringent process when it comes to ICAAP. So while their guidance does not go into into great detail, the level of engagement between the regulator and the bank, going back 7-8 years, that process has been fairly rigorous. But we feel that going forward, the CBUAE will also follow a similar course of action, except that the regulator in UAE has come out with slightly longish guidance on ICAAP. All right. Again, a rehash of what items we'll be covering as part of ICAAP. And if you look at a lot of the sections that have been delineated here, this is also the form that the final documentation typically takes. These are expected areas within an ICAAP report that gets submitted to the regulator. And this is also this closely aligns to the high-level sections within the guidance also. So let's jump in and see what has actually changed, or what are areas of emphasis, and what are conversations that banks are having in response to the guidance. So we'll touch upon a few of these areas, not all of these. So governance in itself, we feel the regulator in the language that it has used in the governance section, there is an explicit expectation that the role of senior management be significantly enhanced. The guidance specifically talks about the role of the chief risk officer, and this again is in sync with what SAMA also does, in that SAMA expects to have conversations with senior management, expects that senior management know a fair bit of the workings of ICAAP, so much so that when SAMA introduced this whole SREP supervisory review process, there was a little bit of an expectation that the CRO or someone of the stature of a CRO be able to have technical discussions on, let's say, how concentration risk was being computed and such like. So definitely focus on involvement of senior management. Secondly, what it has also emphasized on is it's also differentiated between the ICAAP report, which is an annual exercise, but throughout the guidance there is emphasis on the banks looking at ICAAP as not an annual exercise, but to look at ICAAP as a continuous process. That ICAAP is not a compliance exercise that's done annually, but it's several functions coming together, several processes coming together and reflecting in the ICAAP, rather than ICAAP sort of leading a lot of these or putting in place a lot of these frameworks. So frameworks not for the sake of ICAAP, but ICAAP utilizing frameworks within the bank. And this is also reflected in some of the use test requirements, which we will talk about in a bit. Also, purely in terms of compliance, aspect, the central bank has also stated that the board submission, the internal ICAAP reporting needs to be quarterly. So while it is not really defined what this internal report needs to look like, there is a certain expectation on what the regulatory submission needs to look like. The internal, the way the phrasing has been, we feel the ICAAP in some complete form needs to be submitted internally to the board and senior management and internal audit also, as part of the overall ICAAP process. There's emphasis on this not being just a compliance activity. Also, what the guidance talks about is it has this coming in the back of the model risk guidance that the central bank issued previously. A lot of references to the model risk management guidance itself. For instance, the central bank has said model risk needs to be addressed separately as part of one of the material risks, and we'll talk about that in a later section of today's presentation. It has said that the models that are reviewed as part of the ICAAP or developed, reviewed, or any part of the model lifecycle, it needs to be compliant with model risk management guidance. So one, it is ensuring that all Pillar 2 models are part of the overall model risk framework within the bank. And this is something a lot of the UAE banks have already been doing. But again, emphasis on this ICAAP being not looked at in isolation, and it has to be looked concomitantly with the model risk management guidance. Also, what it has spoken about is, again, role of internal audit when it comes to the report to the Central Bank of UAE. Now, again, this is nothing new for banks in UAE, in that the regulatory stress tests, for instance, that were being conducted earlier, there was the role of internal audit that was clearly articulated. Again, for ICAAP also, there is an expectation that 3 months post completion of the submission of the ICAAP report to the regulator, internal audit does its own independent validation and submit an independent report to both board and the Central Bank of UAE. So this again, emphasizing on the point that ICAAP is not just a point in time exercise, it's a through the year exercise. Aspects of ICAAP needs to be done throughout the year. And of course, there are several sections of the guidance that talk about the role of business units in contributing towards the ICAAP process. So an example is again of capital planning, which we will come to in a bit. Role of finance and risk management again have been emphasized in the document. Let's check for time. Okay, on methodology, scope, and capital planning, the requirements are straightforward, but some conversations that we've been having with other clients, there is one, as I was mentioning earlier, emphasis on use test. It is not enough that a report be prepared. One has to demonstrate that frameworks that are used in ICAAP are indeed being used in business as usual environment. So, for instance, a good example would perhaps be if concentration, if you have a methodology for concentration risk assessment, how is that sort of feeding into, let's say, your pricing framework? How is that feeding into your business planning in general, or your risk appetite? So it could, it could take on one or more forms, but there is an emphasis on demonstrating use tests. Models just for the sake of ICAAP reporting, we feel may be looked down upon and likely to receive comments from the regulator that governance around this needs to be spruced up, and models, because one, it demonstrates that perhaps business doesn't have confidence in the model. So the next not debatable point, an area where conversations are being had, is the scope of the ICAAP report itself and the format in which it needs to be presented. Again, I think there are specific points related to the way interest rate risk in the banking book and liquidity risk related aspects need to be computed. But from a pure ICAAP perspective, there is a lot of emphasis on the ICAAP being done on a consolidated basis, on a group basis, as well as on an entity level basis. So this is obviously pertinent only for banks that have subsidiaries, especially banking subsidiaries. And if particular banks have banking subsidiaries, there may be a case of having to conduct both entity level as well as group level ICAAPs and reporting differences or attribute various capital charges both at a consolidated as well as an entity level. Also, we are aware that a lot of banks have had prior conversations with the regulator on this. Some exemptions have been sought, some have been provided in the past. So we don't know yet what stance CBUAE will take going forward. On capital planning, again, fairly straightforward in terms of requirement. Capital planning has to be multi-year, as any capital plan should be. It's not just for current year. 3 to 5 years is what is mentioned in the guidance. It has to be forward-looking. How it differs from regulatory stress tests, for instance, be it CBUAE, be it the PRA, both prohibit the usage of any capital raising plans as part of stress testing. So the CBUAE guidance differs in that aspect. It allows for any changes in its capital base, especially raising of capital, to be included. But it has again said that one needs to assess whether what will happen as a stress scenario if that planned capital raise does not go ahead, and on an as-is basis what the performance will be, which I feel again is realistic and practical. So again, these are conversations that are being had with a lot of our clients. On the material risks, so usually material risks, one talks about just pillar 2 risks, but it is for a reason that the pillar 1 risks are also mentioned here. So straight off, the regulator has, to avoid any confusion, established that it considers interest rate risk in the banking book and concentration risks as material risks. Again, this is in line with prevailing practice. Most banks, to my knowledge, and me and my team have worked with more than 60 or 70 odd ICAAP engagements. Almost always concentration risk and interest rate risk in the banking book are the predominant risks, and typically get and is reflected in the pillar 2 capital charges also. So we feel the Central Bank of UAE has sort of formalized that expectation by naming these two risks as the most material risks. What it has also highlighted is the credit risk, what we consider as pillar 1 sufficiency, what you may put as residual credit risk. Again, some guidance in that area has been provided, especially in the Q&A section. Some banks have asked the regulator as to what PDs and LGDs can be used. So one, it has again established that one needs to assess for residual credit risk, and I'm sure everyone who's a practitioner would be aware the most common way of looking at residual credit risk is the difference between an advanced Basel approach versus the standardized approach. Any difference gets tagged as residual credit risk. What the regulator though has said is put down a few caveats. You need not develop FIRB models if you do not have them. You can use IFRS 9 probabilities of defaults, essentially PIT PDs in lieu of TTC PDs. I guess concept of materiality, proportionality kicks in here in terms of effort. But what it has prescribed is that you cannot use your IFRS 9 LGDs, because I guess it is well aware that in the industry, the IFRS 9 LGDs are much lower than the Basel prescribed TTC LGDs, so as to speak. So I think that clarification has been made, especially in the Q&A section of the guidance. Similarly, on market risk and operational risk, it has said that relying on the base methodologies, be it for the basic indicator approach or the standardized approach within market risk, one needs to have its own internal methodologies for both market risk and operational risk, and the difference of those two be assigned as residual. It hasn't used the word residual, I believe, but it has to be accounted for as part of your pillar ICAAP submission. So residual pillar 1 risk needs to be covered. And it is also mentioned a few risk types within operational risk that needs to be covered. And again, another area of focus that a lot of these banks have had, especially cyber and IT risk, a lot of banks have some form of assessment methodology already in place. So again, the regulator has only formalized what is in place already. Legal risk and other risk types, typically they get assessed in a slightly more qualitative manner. So again, this is a slide that talks to what are the risk types and what assessment methodologies are typically in place. A lot of the pillar 2 risks tend to be assessed in a qualitative manner. Something like a concentration risk or an interest rate risk in the banking book can be assessed in a more quantitative manner, as opposed to, say, reputation risk or strategic risk, which typically get assessed in a qualitative manner. And again, the definitions of what is qualitative and quantitative is very fluid. It's all on a continuum. So you may have a really solid methodology for concentration risk, but the final link function to the capital charge may be slightly qualitative. So the definitions of qualitative versus quantitative are slightly relative, I would say. But as I was mentioning earlier, some additional risk types that have been mentioned by central bank. One, model risk. Two, climate risk. It has there's a brief mention on climate risk, and this is in keeping with other regulators both in the region and globally. There's of course a lot of emphasis on climate risk and the need to develop methodology. We believe most banks, at least in the initial years, will assess climate risk from a stress testing perspective rather than doing a quantitative assessment at this point in time. Going forward, these methodologies may evolve. We know that larger banks are setting up large climate risk and ESG related divisions. A lot of the UAE banks are also doing this, but this will pick up speed perhaps in the next couple of years or so. Year one, we expect these will be met with in a slightly more qualitative manner. Concentration risk, very briefly, again, anyone who's a practitioner is fully aware. A lot of methodologies available. You could do anything from single borrower limits to an HHI based approach, to granularity adjustment based approach, to a slightly more sophisticated economic capital or a simulation model, something that uses what is referred to as the Gaudi methodology, which is to look at the Basel II ASRF framework and to sort of rebuild that formula from scratch, relaxing for certain constraints that the Basel ASRF formula calls for. But and also the regulator has provided individual comments to some banks, saying that if you're looking at something like the Spanish regulators HHI, or what the UK regulator has prescribed, or closer home, the Qatar Central Bank also has prescribed some numbers for HHI calibration to capital charge. The CBUAE has said you may choose any of these methodologies, but you've got to demonstrate that it's a well thought out decision, that these approaches have been looked at in detail and considered, and a final decision has been made clearly to establish that one has not cherry-picked a methodology. So this is a comment that a lot of our clients have received, and I think the way a lot of these banks are trying to do this is try a number of these methodologies and use something that's practical. The trouble with using something like an economic capital based methodology is, let's say you've got to run these models every quarter, isn't it? It's going to be a humongous task to run a full-fledged economic capital model every quarter to explain volatility quarter on quarter and such like. So from an explainability perspective, I'm not sure that using a simulation model will be a good idea. So moving on, we'll not cover all risk types. Reputation risk, because we've had a few conversations with banks who've been asking us, what are quantitative methods for reputation risk? And we feel the state of the industry right now is banks will continue to assess reputation risk slightly qualitatively, either via scorecards, which has modules within scorecards that cover aspects that have been listed down in this slide. Reputation risk will be addressed through stress testing scenarios, but it is highly unlikely that banks will create extremely quantitative methods for reputation risk. We've done POCs in the past where we've tried to create reputation indices for banks mining social media data to keep, essentially build a sentiment analysis model, a machine learning model that will throw out the sentiment score of the bank in question, or the same model can in fact be used as an early warning signal for tracking its own counterparties. But that being said, in light of the requirements around ICAAP, we feel this will continue to be very qualitative in nature. Model risk, again, I won't be able to go into too much detail on model risk, but at Aptiva, we've created certain scorecards that can come in handy for model risk. The idea being that, one, you establish a model risk, a model inventory, and clearly now with ICAAP and ICAAP guidance clearly stating that these models need to be part of your model risk governance process. These pillar 2 models also need to be covered under the model inventory. While this scorecard can take on many forms, the way we look at model risk is to, one, look at model tiering and to create scorecards to assess model risk, which can, one, assess model health, which is, what are data quality sources, when was the model created, what has been the model validation procedure, what are model monitoring plans, what is model performance testing results, what do they look like? And these can be set up at a model level, model type level, etc., etc. Second criteria that we use is to look at model impact. So, you may have excellent model health, but the model impact in terms of model materiality, maybe it's not a pillar 1 or a pillar 2 model. Maybe it's a model that's being used just for informational purposes, no regulatory impact, no business impact, etc. So then on the impact scale, it scores really, really low. And again, the model risk score eventually gets sort of calibrated to that. But model risk quantification in itself is a whole a different area and needs separate treatment. And we feel, given the time frame for banks to comply with the ICAAP guidance, most banks will look at addressing these concerns as part of complying with the model risk management guidance than as part of ICAAP guidance. Last section from me before I hand over to Satya. The stress testing again has certain interesting points from the regulator. It has differentiated and emphasized the difference between internal stress tests and regulatory stress tests. So essentially making the point that you cannot use the same stress testing framework that the regulator has prescribed, as part of the IFRS 9 stress test that typically gets submitted. You need to develop your own internal scenarios and internal stress tests. So that is one thing that's been made very clear. Second, it has differentiated between enterprise-wide stress test versus portfolio specific stress test. And I feel the differentiation is slightly vague. But again, because it has not quite differentiated this between idiosyncratic into systemic scenarios, but has said what is enterprise-wide versus portfolio-wide. So you could have an idiosyncratic scenario, that is enterprise-wide, and yet have a systemic scenario that is just portfolio-specific. So an example for this is, real estate prices going down. It's a systemic scenario, but at a portfolio level. And you might not see enterprise-wide impact on these stress tests. But again, what the regulator has said is, these types of stress tests, stress scenarios need to be identified. Coverage of all material risk types needs to be ensured as part of the stress testing framework. So essentially ensure that all of your material risks are somewhat covered as part of your stress testing framework. To not look at just capital adequacy ratio in isolation, to look at a number of measures. So look at capital adequacy ratio, LCR and NSFR, leverage ratio as part of your stress testing process. ensure that again, stress testing as part of ICAAP gets submitted annually as well as quarterly. So it has gone so far as to say you may choose to revise your stress scenarios and your forecasts on a quarterly basis, but the stress test along with the ICAAP, essentially pillar 1, pillar 2 capital adequacy numbers need to be generated on a quarterly basis, and difference, if any, from the earlier submission to the regulator need to be intimated to the Central Bank of UAE. But there's also some conversations being had as to whether the regulatory stress tests also need to be rerun as part of the ICAAP process. So, while we feel, one very conservative interpretation of the guidance is that you run the regulatory stress test also as part of the ICAAP submission. We feel, I mean, again, this is a point that the regulator is best placed to clarify. We feel that was not quite the intention. The intention is not that the regulatory stress test be rerun in its entirety, the full-on bottom-up stress test be rerun and submitted to the regulator as part of the ICAAP, as part of the ICAAP submission, annual submission. But that these are frameworks that come together as part of the overall ICAAP scheme. So we don't think, for instance, in the March 31st submission, the regulatory stress tests need to be rerun and submitted. Anyway, again, this is our point of view. The regulator, again, is the best place to clarify something like this. There is also an emphasis on reverse stress testing. Again, this is something that was highlighted in the earlier guidance also. The reverse stress testing needs to dovetail very closely to the business model assessment or the strategic risk framework of the bank. So essentially identify multiple reverse stress testing scenarios that are plausible, identify mitigation strategies, and what are remediation strategies, and all of those remediation strategies need to be plausible and documented and ratified by the board as well. So again, something this I believe is something that is very close to whatever recovery planning frameworks have been developed. So a lot of those frameworks also need to come in, especially for those banks that do not have a very sophisticated reverse stress testing framework. So that sort of brings me to the end of my talk. I will hand it over to Satya. The slide essentially talks about ICAAP submission like easily. I mean, of course, the executive summary in itself would cover everything from pillar 1 risk, the capital charge for it. It will cover capital planning. It will cover stress testing. It will cover reverse stress testing, the results of it, and any remediation. And it will also cover the main policies and procedural frameworks that all feed into the ICAAP process, and any planned validation related to ICAAP and remediation that have happened in the past. So these are items we believe the executive summary covers. The main document itself, along with annexures, etc., easily goes above 100 pages, and any supplementary information in the form of policies and procedures get submitted to the regulator. That sort of brings me to the end of my talk.
Actually, there are a few questions in the Q&A section. Just
okay. Let's. So I think the two questions here, questions related to model risk and capital risk. Is there a pillar 2 capital requirement, and how does one quantify this? So again, this is very qualitative in nature in general, I feel. The framework for, in fact, let me try and show if I can bring up a model risk framework. Interestingly, I'm also doing another webinar on model risk in the coming week. So while I sort of bring this up, so I feel Sorry, I'm sort of unable to bring this up. Perhaps we'll have to wait for the model risk seminar. We have a scorecard in place that looks at the model risk in terms of model inventory, model health, model impact, details on how the model was built, details on the model performance. There is a model classification theme that gets set up as part of the overall model risk management. Any deviations from that, essentially it's a notch up or a notch down in terms of your model risk score. And essentially all of these will eventually feed into a capital requirement. So we had a schema in place wherein we were sort of able to look at volatility of the model outputs, the importance of the model, and to assign capital charges based on that particular model volatility. This is especially true for IFRS 9 models, which is where a lot of the model development and model validation work has actually happened. But I must say the final linkage to capital charge in itself is sort of judgmental in nature. That being said, the question really is there a pillar to capital requirement? I think there is a capital requirement, just like there is a capital requirement for reputation and strategic risk. It may not be a large capital requirement, I feel, but the bank needs to demonstrate that it has indeed assessed these, both model risk and climate risk. Climate risk may be tackled more on the stress testing side of things, and one may demonstrate that under a particular climate risk scenario, if let's say losses to a bank are more than so and so percentage, this is the extent of capital charge that you would set aside, or some such thing. So banks generally at this point in time tend to be a little creative. For instance, a particular client we worked with a few years back had exposures to farmers in Brazil. So essentially, if climate if climate change were to take on the path that people are talking about, if temperatures were to rise, the impact on the Amazonian forests, impact on the agricultural sector within Brazil, what would be the increase in probabilities of default in the Brazilian portfolio? And commensurate to that, a particular capital charge was attempted to be assessed. So we see that initially, till these frameworks sort of evolve, banks will be a little creative with this. And I think that is really what the regulator is looking for at this point in time, that conversations be had, and frameworks can eventually evolve. So yeah, and I think there's another question on how the ICAAP output itself is stress tested. I think I think really the question here is how does stress testing feed into how does stress testing feed into the capital planning? So again, couple of questions really here that the bank needs to consider. Is it going to conduct stress testing on a static balance sheet basis or a dynamic balance sheet basis? So the regulator hasn't quite clarified what the expectations are there, but if you look at guidance and read it very closely with the capital planning guidance, one would imagine that there is an expectation that some dynamic balance sheet aspects be considered as part of stress testing. So really the answer is the ICAAP output itself is not stress tested, but the stress testing framework should use the pillar 2 assessment frameworks while presenting its view of how the balance sheet and P&L will look like. Okay, I think I will hand it over to you, Satya, now.
Sure, thanks, Ashley. So let me present screen. Yeah, hopefully the screen is visible. So in the same line that Ashley explained in terms of the new ICAAP guidance from CBUAE and how what kind of qualitative and quantitative impacts might have on the submission. So on the IRRBB side, so CBUAE has issued a few regulations previously as well. One starting with the ICAAP guidance itself refers to these four main regulations or standards. One issued in 2016 by BCBS or BCBS 368, the Basel IRRBB standards. And then in 2018, CBUAE issued a circular on the IRRBB regulations, where it was largely principle driven. And now in 2022, in November, again, the regulator issued the model management standards and guidance, and where specifically the guidance document adopted a number of provisions that were prescribed as part of the 2016 Basel guidance. In terms of computing the NII and EV and the standard 6 shock scenarios, so on and so forth. And then that brings us to the the December circular relating to the capital adequacy standards, where again specific methodology has been prescribed and refers extensively to the model management guidance document with respect to how interest rate risk is to be measured. Just to start off with a brief background. So IRRBB, is part of normal part of banking activities. So it's part of the maturity transformation, where short-term deposits are taken in by banks, and those are used in turn to give out medium to longer term tenor loans. So this transformation in maturity, it's also accompanied by the pricing aspect. So the short-term deposits get shorter rates, while the assets are priced using slightly longer tenor rates, and therefore yield higher. So this spread purely coming from the pricing of the deposits and pricing of the assets, excluding the credit spreads that are specific to the client credit assessment. So this margin is a important source of profitability for banks. And if there is excessive mismatch in terms of these gaps, in terms of how short-term the the liabilities are and how long-term the assets are, this can raise exposures of the bank to excessive IRRBB and can pose significant threat to earnings and capital base. So from earnings perspective, from an overall regulatory perspective, IRRBB is part of the Pillar 2 framework. So that means there is no Pillar 1 requirement, and that means the entire risk and not just the residual risk is measured as part of the Pillar 2 exercise. And the CBUAE expectation is that banks should set up standard and identification, measurement, and control activities around IRRBB and strengthen its supervision. In terms of understanding the risk itself, so how does IRRBB in turn impact the capital and the capital requirements and capital adequacy perspective? So in terms of accounting perspective, a direct impact of interest rate risk on capital comes from the net interest income computations and the impact of changes in interest rates on net interest income. So from an internal capital generation perspective, usually NII is a major component of internal capital generation. So every year, the additional income that the profitability of the bank gets added to the capital base. And so any risk to that internal capital generation is a direct risk to the capital. So that's the first aspect. And the second aspect is any portfolios that may have an accounting impact on the capital available in terms of OCI portfolios, and even from a long-term perspective, the valuation of the banking book assets and liabilities, and the changes in those valuation, how they in the long term impact the economic value of the equity. So these two aspects are fundamental to the long-term sustenance and retention of value of the bank. And if there is excessive risk and there are large adverse changes in the interest rates over the long horizon, so the overall valuation of the bank will be significantly impacted, and the valuation of equity itself and the the available capital base itself will erode over a period of time. So that is basically the idea, and given the regulator wants banks to measure the risk in terms of NII and EV, and how those two measures can be used to set aside the capital from a capital adequacy perspective and ICAAP perspective. And the overall, given even though the IRRBB framework, specifically this exercise is part of the ICAAP, but the guidance is clear that it is not just for the sake of computing only the capital requirement, but the entire risk management framework around IRRBB should be strengthened as part of the ICAAP exercise and the normal risk management exercise. And specifically technically in terms of the definition of IRRBB, current or prospective risk to the bank's capital and to its earnings arising from adverse movements in interest rates on the banking book. So that's the definition of recognized definition as part of Basel and also adopted by CBUAE. And there are three key risk types that Basel has defined. Gap risk, which arises from structural mismatch in terms of the repricing positions of assets, liabilities, and off-balance sheet positions. And this structural gap risk again, will be impacted adversely depending on whether the changes in the term structure of the interest rate curves, over a period of time, in terms of whether it is a parallel change or non-parallel change in the yield curves. So that adds on to this, inherent gap risk of the bank. So the CBUAE uses an additional terminology called yield curve risk in addition to the gap risk, but Basel classifies both under gap risk because they are both related and how interconnected they are. And the second aspect is the basis risk. So where basis arises is if assets and liabilities, even though they may have same repricing tenor, are pricing are priced using different interest basis. This could be coming because of different currency basis or different rate benchmarks. For example, asset priced on LIBOR and liabilities based on SOFR, or vice versa, or or simply different indices like overnight indices spread, index spread versus LIBOR. So there are a number of different ways in which the pricing could differ, leading to basis risk on the banking book. And the third aspect is the option risk. So the option risk is essentially any optionality embedded within the positions that can change the cash flows of the customers, either on the liability side or on the asset side, due to any change in interest rates. So this could be any explicit optionality embedded within the positions, like call options, put options, for example, or implicit optionalities like prepayment options, early redemption option, and callable liabilities which can get called on short notice. So there are a number of other optionalities that can be part of the book, like rate floors and rate caps that can get applied on asset transactions. So these, so as part of the measurement, so all these risks need to be computed. And one additional risk that is part of the Basel framework, which has not been adopted by CBUAE as of now, is the specifically, there is no specific mention to this risk, is the credit spread risk on the banking book. So this is this risk is related to positions which have traded equivalents in the market, and there is a risk of perception of change in credit profile of these instruments, because of which there is change in valuations. So it is not due to outright default of the instruments, nor is it because of a change in interest rates, but because of change in perception of the credit worthiness of these instruments, because of which there is valuation change and therefore EV impact. However, for the scope of this discussion, we'll keep this outside, because there is no clear guidance even from Basel with respect to CSRBB, and even global banks have not yet fully started looking at this risk. Some banks have, but at least in GCC, there is no specific requirement, and only recently regulators have started asking banks if they are looking into CSRBB or not. And specifically in terms of governance, with this specifically from ICAAP perspective, there is no significant change from the 2018 guidance in terms of board being responsible, ALCO being monitoring the IRRBB on a monthly basis, specifically setting aside risk limits in terms of NII and EVE, and aligning the IRRBB framework with the capital framework in terms of ICAAP. And from a measurement perspective, having well-defined behavioral models that identify slotting repricing profiles of non-maturing deposits, embedded prepayment behavior in fixed rate loan portfolios, and also redemption behavior in term deposit portfolios. And the requirement around validation and regular testing of these models and documentation. So that is already part of the overall principles of IRRBB, and it continues as part of the recent model management guidance as well. And then from a supervisory review and disclosure perspective, there's an annual requirement to publish interest rate sensitivity as part of the annual statements, and quarterly requirements in terms of the Pillar 3 disclosure around interest rate risk in the banking returns. And from a supervisory perspective, banks which have higher than 15% EV threshold, EV sensitivity with respect to the Tier 1 capital are marked by regulators for specific review in terms of asking them to hold additional capital buffers or reduce the risk exposures or strengthen the risk management framework. Now, the 2018 guidance of CBUAE specifies this limit at 20%. However, again, the recent model management guidance, which refers back to the BCBS guidance, again, mentions the 15%. So I would assume that the given the most recent guidance is the model management guidance, so the 15% threshold of Tier 1 capital would be the new limit in terms of EVE for banks in the UAE. As we just discussed, the CBUAE standards, this is the other document that is referred to in the ICAAP, guidance. So this is largely in line with what Basel has already mentioned. So we'll not go into repeat of this. But here, what previously CBUAE has asked banks to look at is conduct sensitivity analysis for 200 at a minimum 200 bips parallel upwards and downward shock scenarios. And the change in EV, considering basis risk, yield curve risk, and gap risk, and then compute the EV change as part of the Pillar 2 capital requirement. Historically, banks, given the lack of specific guidance, banks have adopted a number of approaches like historical simulation by looking at a particular holding period of historical changes in interest rates, and computing, given the current repricing gap of the bank, computing the EV based on historical changes, and then deriving tail percentile number in terms of similar to a VAR approach in terms of the worst case EV, 1 percentile worst case EV based on last 5-year simulation. Or banks have also looked at considering just 200 bips parallel up, parallel down shocks, or even the 6 shock scenarios prescribed by Basel, or even worst case of all these aspects. And some sophisticated banks have also considered not just the shock scenarios, whether it be the standard shock scenarios or historical scenarios, but also bringing in stress from other risk factors like credit and liquidity onto the repricing gap and recomputing the impact from from a creditor's perspective, bringing in the impact of the NPAs, increasing NPAs on the repricing gap. From a liquidity perspective, bringing in the impact of the runoffs on the deposit side on the repricing gap, and then recomputing the sensitivities to then assess how that stress combined with interest rate stress can identify inherent interest rate risk on the banking book. Specifically, the methodology, the current methodology prescribed by CBUAE, for Pillar 2 capital computation, just looks at, at a high level, it is to compute NII and EV sensitivity for all 6 shock scenarios. Well, the differentiation, in terms of Basel, required so far to compute NII sensitivity only for parallel up and parallel down scenarios. However, and for the EV, they asked to consider the 6 shock scenarios. But the current guidance specified by CBUAE asks banks to compute all the 6 shock scenarios for both NII and EV. And then, and of course, I mean, as per Basel, the NII with sensitivity should be computed separately for all material currencies. So material currency definition is any currency which has more than 5% of, either on the asset side or on the liability side. Should be considered a material currency, and NII and EV sensitivity should be computed separately. And then the worst case for each currency should be conservatively added up, both for NII and EV across the scenarios to get the absolute worst case impact from NII and EV. And the capital allocation from an IRRBB perspective, the specific guidance that CBUAE has given is that the maximum of absolute worst case change from EVE and the absolute NII impact should be considered, as a capital charge. There is slight, difference in how Basel treats NII sensitivity versus EV sensitivity. Basel, in its guidance, has mentioned that NII sensitivity specifically talks to the capital buffers. In terms of the current year, how much buffer, additional buffer, like in terms of counter-cyclical buffer or the other capital conservation buffer, how banks plan, through the business cycle in terms of what's the level of buffers they need to hold. NII sensitivity talks to that kind of a buffer. That means within the next 1 year, in the short-term horizon, what kind of realistic impact that changes in interest rates can have on the NII of the bank, and therefore how much additional buffers that bank needs to hold to mitigate any reduction in capital growth on account of NII reduction. Whereas the EV sensitivity is looked from a capital adequacy perspective. That means EV sensitivity is looked at from an RWA computation perspective. That means any change in EV is then converted into a RWA number and taken to the denominator for capital adequacy computation. Whereas NII is looked at from a capital buffer, direct capital requirement perspective. However, for the CBUAE Pillar 2 requirement, they have directly asked banks to consider the maximum of absolute worst case change in EV and absolute worst change in NII, sensitivities. And in terms of the scenarios, as I mentioned, they've asked to consider all the 6 scenarios, and for DSIBs, they've also considered asked to consider idiosyncratic scenarios, which are specifically, again, as I mentioned, specific to the balance sheet of the bank in terms of other risk aspects and how it impacts the repricing gaps, and also historical shocks experienced by the bank. Any specific holding period can be considered for change in interest rates. So typically, the holding period for change in interest rates is a function of how quickly the bank can hedge its interest rate risk. So, for example, if the bank feels that it can, from the point of identification of excess interest rate risk on the banking book, it can take measures like either through issuance of long-term debt instruments or issuance of or entering into rate swaps that will hedge the interest rate risk. If the time horizon to take those actions, including the internal approvals and review and so on and so forth, let's say is 90 days. So then the holding period that the bank can consider, should be 90 days. But the shock scenarios that Basel has calibrated, looks at a 1 year perspective to be more conservative. But for internal modeling perspective, banks can consider 90 days, 180 days as well, other than the 1 year horizon. So, coming to the NII EV methodology itself, again, this is something given so far. There was no specific guidance from CBUAE. The 2018 guidance doesn't really talk to how the NII and EV sensitivities are to be computed, and only in the recent model management guidance that these methodologies that refer back to the 2016 Basel guidance have been specifically mentioned. So obviously, from a definition perspective, it is clear now what is NII sensitivity and what is EV sensitivity. And from a time horizon perspective, NII considers a short-term horizon, typically 1 year. And there is a slight distinction that CBUAE makes in a number of these assumptions, what they recommend for normal banks versus LSIs. LSIs are large or sophisticated institutions, which the definition is slightly fluid. That definitely DSIPs will be part of LSIs, but any other bank which also has significant exposure to IRRBB is also considered LSI. So for those banks, CBUAE has also asked them to not just consider 1 year horizon, but 2 and 3 year horizons also, to more accurately assess or more conservatively assess the inherent interest rate risk. Whereas EV looks at a runoff balance sheet, and basically discounting of assets and liabilities. Commercial margin is a very important aspect that we have seen that most banks don't properly consider, in that from an NII computation perspective, the entire interest income that comes from the customer and paid to the customers on the deposit side should be included. So what this means is not just the interest component, but also any spread components due from the customers are included in the NII sensitivity computation. Whereas in the EV, if the cash flows do include the full interest cash flows coming from the customer, but this means that spreads related to credit margins or credit risk are also embedded in those cash flows. And so to avoid any impact of credit risk on the computations of interest rate risk, the discounting curves should also incorporate a margin corresponding to the credit spread of the portfolio. So either banks can exclude the credit component from the cash flows and discount using pure risk-free rate, or if they are going to take the full cash flows from the customer, then they have to ensure that the risk-free rate is adjusted with the credit spread of the portfolio that is being discounted. And this is very important because we don't want any impact of difference in credit profile of two banks getting reflected in the EV computations, which should ideally only reflect the interest rate risk of the book. And then from a balance sheet assumption perspective, for NII is a constant balance sheet assumption. However, for LSIs, CBUAE has also asked to consider a dynamic balance sheet where growth assumptions also come into picture. And EV is simply a runoff balance sheet either way. And in terms of capital treatment, the EV sensitivity should exclude all capital own capital from the computation. So that means the shareholder equity as well as any additional tier 1 instruments need to be excluded from the computation of EV sensitivity. So this is a represented diagram of the standard process that Basel has recommended and has been adopted by CBUAE for EV computation, where repricing cash flows are slotted into 19 standard buckets, and then discounted under the 6 shock scenarios. And in addition to the the standard contractual cash flows which have standard defined repricing tenor, other aspects which are not amenable for standardization, which are non-deterministic, where behavioral modeling will be required, and other aspects which are less amenable, which are optionality related, where the valuation of the options should be separately conducted for each of the scenario, and then finally aggregated into the final EV worst case computations. And I mean, this is a representation of the overall shock scenarios. We'll also talk about rate floors. In terms of practical considerations, specifically in terms of the model guidance that CBUAE has issued, a few aspects that the regulator has drawn attention to is that unlike on the credit side, where the portfolio analysis looks at doesn't look at the entire balance sheet, it only looks at specific portfolios. Whereas from an ALM perspective and IRRBB's perspective, it is very important that the entire balance sheet gets represented in the computations, whether it is interest rate sensitive or non-interest rate sensitive, but it has to reconcile. The balance sheet used for IRRBB computation should reconcile to the ledger or the published financials. The second aspect is computational granularity. Here, the regulator has given some leeway to smaller banks or normal banks which don't have excessive exposure to use simpler computation approaches, where first of all the balances are slotted into gaps, and the net gaps are computed, net of assets, liabilities, and off-balance sheet items. And the EV can then be computed, or the NII sensitivity can then be computed at the gap level of the 19 standard buckets. Whereas for LSIs, the requirement is to compute NII and EV sensitivity at a facility level, or for certain portfolios which are homogeneous, for retail portfolios, where there could be millions of transactions. So regulator has given option to consider homogeneous pools. So this eases the burden of computation by quite a bit for normal banks, whereas LSIs will continue to use systems, given the requirement to compute at a facility level. And from a scenario perspective, again, normal banks should at a minimum consider 6 standard shock scenarios, while the regulator again has recommended to consider additional historical scenarios and idiosyncratic scenarios, like we discussed earlier, to LSIs. And computational tools, again, as I just mentioned, Excel-based spreadsheets are allowed for normal banks, whereas LSIs are mandated to have dedicated systems. And for the forecasting horizons, we just discussed this, 1 year for normal banks, whereas 1 year, 2 year, and 3 year horizon for LSIs. Interest-bearing equity, instruments. So there, the guidance talks about 2 methodologies, of whether to include or exclude, interest-bearing equity instruments. From a risk measurement perspective, banks are allowed to include additional tier 1 instruments as liabilities, whereas from a Pillar 2 IRRBB capital computation perspective, they have specifically asked banks to exclude any interest-bearing instruments from the capital. So that means the total capital base will include these additional tier 1 instruments as well, because the entire tier 1 is included in the denominator. So all tier 1, including additional tier 1, should be excluded from EV computation. And basis risk. So basis risk should be addressed by considering specific curves for instruments that price using specific types of curves or rate benchmarks. So for example, instruments that are using LIBOR or instruments that are using SOFR should be appropriately discounted by appropriate risk-free rates. And the shocks should also be considered, commercial margin should also be considered as part of the shocks. So this is an interesting thing that Basel has not recommended, but the CBUAE has recommended, is that when banks define historical shocks or custom shock scenarios, typically banks look only from the interest perspective. But what here CBUAE has recommended is to also consider changes in commercial margins that they may anticipate under stress situations. So if there is tomorrow there is a very low rate environment prevailing, that doesn't mean that banks actually pay very low interest rates. There is certain minimum level of interest rate that is paid to depositors. So that means the commercial margins should be increased. So those type of considerations have also been recommended, but that is for sophisticated banks only. And currency risk we just talked about in terms of materiality and aggregation, conservative aggregation across shocks. And specifically from a shocks perspective, banks can consider for AED the same shocks as USD, given it is a pegged currency. But specifically, CBUAE has given permission to offset risk between pegged currencies, specifically AED and USD, if the banks have considered the basis risk in their computations. That means if they have sufficiently differentiated the discounting basis for instruments priced using different rate curves. If that is demonstrated, then banks can consider offsetting between pegged currencies. Otherwise, no offsetting is permitted. And for non-performing assets, from an EV perspective, NPAs need to be slotted into certain time buckets based on the recovery estimates of the bank, considering the LGDs. And from an NII perspective, they have given the option to the banks but the default assumption is that no interest will be accrued on these positions. And finally, on the negative interest rates, CBUAE has asked banks to look at their contracts with the customers. If there is a specific requirement on floor, either at 0% or whatever floor, then those should be considered as it is. If not, negative interest rate shall be considered on asset side. However, on the liability side, 0% floor by default should be applied, given that CBUAE feels that there is no evidence to suggest that either retail or corporate depositors will accept negative rates, to place their deposits with the banks, specifically within the UAE. So this is again, this will create, certain, unsymmetry or dissymmetry between parallel up and parallel down results, where on the one hand you have 0% floors applicable on liabilities, whereas negative rates are allowed on the asset side. So these are a few practical considerations that are specifically different from Basel, with respect to the CBUAE guidance, and those that need to be considered for IRRBB.
Thanks, Satya. There are a few questions for you.
Yeah, I think there are a few other questions related to capital only, but I don't think. Okay, let me just quickly look if there are any other. So there's one question related to calibration of the shock scenarios, given the Basel calibrated shock scenarios have been done under a low interest rate environment. So that is where the requirement of CBUAE for banks to actually consider their own historical rates. So the banks need to the methodology that the Basel has used to calibrate the existing shocks has been documented in the Basel standards. So the same guidance can be used by banks to calibrate their own shock scenarios, or recalibrate those standard shock scenarios using the recent historical data. Definitely the recent historical data shows much higher shocks compared to the definitely compared to the parallel shocks of 200 bips up and down. So there is more than 350 bips change in interest rates. So definitely, as part of the stress testing, banks definitely need to consider the most recent data and recalibrate shocks based on that. There was one question, NII as well for 6 shock scenarios. Well, that is what the guidance currently says. They clearly mention in the the capital standards document and the ICAAP section for IRRBB that 6 scenarios should be used for both NII and EV. So that is pretty much clear. Commercial margins not required at a deal level. This can be done at a portfolio level. So you can have certain granularity in terms of how you differentiate between similarly credit rated portfolios. So for example, if you take your corporate portfolio, so you may consider maybe 3 or 4 different rating bands, which could be considered homogeneous within each rating band, and then compute the average margin for that portfolio and apply that separately for each portfolio. Or for simple banks, you can even consider at a product level, you consider a single commercial margin and apply it on the curve. Deal level computation is not required unless banks adopt the other approach where the cash flows itself are computed excluding commercial margin. So there you'll be required to compute cash flows without commercial margin. So that will be at a deal level. Okay, so the last question is, what's the point in considering non-rate sensitive products while computing NII EV? Okay, see, non-rate sensitive products from a NII perspective, they are definitely not applicable or not relevant, given they don't accrue any interest. But even there, CBUAE has asked banks to look at for example, current accounts or non-interest bearing accounts, typically. But CBUAE has historically, mentioned repeatedly, even as part of the stress testing exercise, to consider what portion of non-interest bearing accounts could convert into interest bearing accounts if there is an interest rate stress scenario. So that is one, kind of analysis that CBUAE has asked banks to perform as part of their behavioral models to understand the transition from non-interest bearing to interest bearing deposits. And from an EV perspective, EV computation does not necessarily only relate to interest bearing aspects. So it is basically, present valuation of assets and liabilities. So that means we are just looking at the cash flow profile of assets and liabilities, which includes both principal and interest cash flows. So from that sense, if you have a behavioral profile of your non-interest bearing accounts, that means, let's say you say that, at least 40% of my accounts are stable and they will not run off until 5 years. So you slot those balances in 5-year or above 5-year bucket, or you derive a slotting profile based on your behavioral analysis and then slot the non-interest bearing accounts into those behaviors. So that means you have assigned a specific cash flow profile to your liabilities. And the EV is just looking to discount the cash flows. It doesn't bother itself to look at whether there is interest bearing or not. So from that perspective, non-interest bearing accounts will help you reduce your EV exposure. And this has been specifically mentioned in the Basel guidance as well, that both, interest bearing as well as non-interest bearing deposits should also be slotted when computing EV. Of course, there are other operational items, for example, cash or other assets or other liabilities, which typically are, very transient in nature and don't really, enable themselves to discounting, from a typical cash flow discounting perspective. So for those items which are always recognized at book value, you can continue to, recognize them at book value. Yeah, I think that covers from an IRRBB perspective. I think there are a few other questions, Ashley, that if you want to take from a, overall ICAAP perspective.
Just looking at, I think there's a very template-specific query, which honestly I'll have to look up. I don't have a straight answer right now. And also it's a question from George, and also it does seem like a kind of question that is best clarified by the regulator as to expectations around the template. Nothing else. I think we will share the presentation with you all. There's a request from a couple of members about the presentation being shared. We'll of course make this presentation available, the recording as well as the PowerPoint template. We thank you all for joining this webinar. There is another webinar coming up next week. Hope to see you all in that webinar as well on model risk management guidance. Thank you. Thank you, everyone.
Thank you. Thanks, everyone.